In May, two memory chip makers, Micron and SK Hynix, were responsible for roughly 17% of the entire world's stock market gains that month. Not the chip sector's gains, the whole planet's. These two companies make up barely 1% of the global index, yet they single-handedly hauled markets upward. It's a strange kind of dominance, and it raises an uncomfortable question. If two companies almost nobody outside finance has heard of can lift the entire market, what happens when they fall? To be fair, there's no consensus that a crash is coming. Plenty of credible investors believe AI is a genuine economy-reshaping technology, and the sheer scale of spending by tech giants suggests they believe it too. This isn't a doom prediction. It's a look at how much is riding on one bet. The uncomfortable part is how far AI exposure has spread. It's not just chip makers, it's utilities powering data centers, real estate firms building server warehouses, and construction crews pouring concrete for new facilities. Even escape strategies aren't clean. Small cap funds turned out to be stuffed with semiconductor suppliers, and value investing indexes accidentally loaded up on big tech after a routine rebalancing swapped chip stocks for Amazon, Apple, and Microsoft. So how much money is actually at stake? Estimates vary, but they land in the same ballpark. Economist Dean Baker calculates that if valuations simply reverted to historical norms, no crash, just normalization, around $40 trillion in market wealth would vanish. Economist Geeta Gopinath puts a dot-com-style correction at roughly $20 trillion in U.S. losses, plus $15 trillion abroad. Consultancy Oliver Wyman estimates $33 trillion. For scale, the actual dot-com crash wiped out about $6 trillion, meaning today's exposure could be 5 or 6 times larger. This matters more now than it used to, because stocks recently overtook real estate as the biggest source of American household wealth for the first time since World War II. A market downturn no longer just hurts the wealthy. It reaches into the middle of the economy through reduced spending, layoffs, and stalled construction, since a huge share of recent U.S. growth has simply been data center building. There's also a hidden layer of risk. Journalists have found trillions of dollars in AI-related spending commitments tucked into corporate footnotes rather than headline capital expenditure figures, an iceberg far bigger than what's visible. Meanwhile, lightly regulated private credit funds have poured money into AI-adjacent companies, and troubled loans in that sector have been climbing toward levels not seen since 2017. History offers a caution, not a verdict. The Bank for International Settlements compares today's AI build-out to Britain's 1840s railway mania, a real transformative technology that still wiped out 2/3 of investor value when the excitement outran the fundamentals. Being right about a technology and being right about its stock price are two different things. Amazon proved to be a correct pick after the dot-com bust, yet still fell 90% and took a decade to recover. Still, bears have been wrong for years. Tech bubble warnings have circulated since 2011 without stopping the rally. Nobody can reliably time an exit or a re-entry. The real takeaway isn't to sell everything. It's to make sure your portfolio isn't quietly all in on one story. True diversification means holding some unglamorous assets that don't move in lockstep with the exciting ones, so that when the hottest trade cools off, you're not left standing on your own.